Oh, hello, everybody. Um, Good afternoon, good evening, good, good everything. I'm very, very excited to be here today. Just very excited. I just wanted to say a big thank you. I'm always starting with a thank you to everyone that has watched this show. My name is I'm Dr. Inibega Desonya, and this is the Dr. Inia Desonya show, formerly for podcast. Now I know that we have been having music at the beginning, but working on that. So just bear with me that we're going to get that situated, but it doesn't prevent me from giving you fantastic information, right? And so happy to be here this wonderful day. And we're going to get started with a very wonderful topic, but still wanted to say a big thank you. People have commented, watched, given good suggestions. So very grateful, very happy to be here. All righty. So today I'm going to talk about the implication of back taxes, right? How do you prevent that and some options to get out of it? Now, I know somewhere, I think I mentioned back taxes here and there, but I just really wanted to zero in. This is going to be a topic that is, all my topics are worth listening to. So, but it's good to sit back and listen and watch, because a lot of times we hear about back taxes and, oh, yes, taxes are behind, but we want to make sure that what happens when you do have back taxes and how you can prevent back taxes, and of course what options are there for you. All right, so let's get started. Okay, now what happens if your back tax, what is back taxes? Before you say back tax is just like it says, back taxes, taxes that are back, that you've owed in the past, right? And unfortunately, for taxes, when you look at Internal Revenue Service, taxes that you owe from the past accumulates to the present. All right. Sometimes you owe money and it just stays there and say, oh, you're owing 40,000. Okay, that's the $40,000 debt that you're owing. But in IRS case, in the case of the Treasury and the IRS, which is under the Treasury, yes. So what happens is that, the tax that you owe will accumulate and continue to accumulate and continue to accumulate. That's why you wonder, okay, but I thought I was owing this amount. How much? How come it's tripled 3 times? So yeah, that's what back taxes are. What you owed in the past but continues to accumulate to the present. All right. Now, what are some things that IRS can do if you actually have back taxes? Right now, usually I would say that, if you don't notify IRS and say, okay, this is this is what's happening to me, then there's going to be enforcement action. Enforcement action means that it's like, how do I get my money? Think of somebody owing you. Now, I say this, well, when I talk about this topic, I always do this analogy. What I say, okay, what about if somebody's owing you? Would you be happy if the person just ignores your calls and stops talking to you? Or some people even say, why are you bothering me? Is it just this little amount of money, which is not little when you gave it to him or her? You know what I'm talking about. So they'll say, oh my goodness, why is she or why is he calling me? Is it because of this little money? Well, and then you get mad. You get, oh, why should somebody behave like this? Well, when we're looking at the platform of when we're looking at the internal revenue service, they don't just get mad, they take action. And these actions that they take are enforcement action. Now, I started by saying that if you have issues, do not just say, oh, you know what, I'm not gonna talk to them, right? If you have hardship, things happen, right? Things happen. Life happens, things happen. Make sure you actually, reach out and say something. All right. Now, if you haven't done that and just ignore, think of the person ignoring you, right? Ignoring, well, this is the same thing, ignore. Now, what happens is that, right? there are a couple of things IRS would do, and I'm going to mention it because sometimes we don't know the seriousness, the gravity of what we do when we say, you know what, I'm not going to even respond to any levy. I'm not going to respond to anything. So what IRS can do is that they can issue a notice of levy, right? So what happens? A notice of levy, it permits IRS to what? Seize, right? Seize your property, let's say your property, maybe you owe, let's say 50,000 and your property is worth 100,000. They can seize it, but they'll pay you, they'll give you back the difference. They just want to satisfy the debt, right? They can seize your vehicle. They ask you what you have. They can actually, and you might say, oh, I'm not going to tell them what I have, but they know they have access to records. All right. So we're talking about a business person, right? Someone in the business that says, you know what, I'm really not really going to pay these taxes, back taxes. Now, we know that there are different kinds of structures, and I'm going to talk about some ways that you can get information towards the end of this program today. So, but just know that a levy can be issued, and they can come after your property. IRS can come after your building. They can seize it and say, I want to satisfy my debt. Right? I want to satisfy the debt, right? And that's one of the things. Another thing they can do, remember talking about enforcement, there's something called trust fund. And some businesses actually have this issue because they refuse to remit taxes, payroll taxes. Now, and then people will say, oh, but I don't have a trust. Why is it a trust fund? Now, what Congress says, or what Congress saw it to be, because they enacted this legislature, and they said, usually when people give you money to remit, they're trusting you, right? They said, okay, I'm trusting this A and B company or C and D company to remit these funds. They're saying that, yes, I'm trusting. I know that they're going to do it, right? Now, if you don't remit their payroll taxes, then you betrayed that trust. So what happens is that, there's a trust fund levy that can be put on the company for unpaid employment taxes. And of course, IRS will look for every way to collect that money, any way they can. They can even seize your accounts, right? They can seize your account. So the issue here is that are you owing employment taxes? All right. So we're talking about enforcement. Then another way to enforce is issuing of summons. IRS can actually issue summons to even third parties, maybe even to your banks, your vendors, they can issue summons. And usually when they issue these summons, they actually can prepare your unfiled tax return. In case sometimes people even say, you know what, I'm not going to file my returns. Now, there is a threshold that you have that you could actually get to, or you could be below. I would say below that threshold, you don't really need to file. But because of the way tax law changes, I advise people, go ahead, just file the return. Just go ahead and file it. I mean, the simple return, just file the return, because tax laws continue to change, thresholds change, your situation changes, right? Maybe somebody, you get some money, you have a cancellation of debts, anything can change in your arena, and thresholds change, thresholds continue to change under the tax law. So I would say, if you're not sure, just go ahead and file the return, because honestly, IRS can say, okay, I'm going to file your return for you. I'm going to take the information and file your return for you. Now, somebody might ask, oh, what happens if someone doesn't really, doesn't answer the summons, right? There are implications, right? It could be, there are a lot of implications if someone doesn't really answer those summons. And, the summons, it's a legal document. So, you get a summons, you said, no, you're not going to answer it. We know what can happen. It can go to another level, right? You don't want to say that you're not responding to summons. A legal document, you have to respond, right? You have to respond. So we're looking at, and then of course, we're not even talking about you. We're talking about your vendors, your customers will respond and say, yes, this is what happened. I gave him this work. This is the income right? And remember, the deductions, really, most of the time, we business owners, we actually push for the deductions that, oh, we traveled here, we traveled there. Because the IRS doesn't have your deduction, they really have your income, because people that pay you usually send a 1099 to the IRS. So because you don't have any deduction, what happens, the IRS will tax you on that income alone, and then back taxes happen. So, I have seen cases that because of not even responding to notices, right? And then because of that, and that not responding caused there to be back taxes, and then because of interest and penalty, and even that, because not responding actually resulted in the penalty and then interest, and the calculation was they denied, or the deduction was denied, and because of not responding, taxes had to be paid. So make sure, again, issuing of summons, we're going to talk about how to prevent, but we're still in the arena of what happens. Then there's federal tax liens. Now, what happens? A lien protects the government. Now, you might have a house and you said, okay, I have back taxes. I say, okay, if you think of selling that house, if you're thinking of selling that house, the percentage might have to be paid first. I must be paid I must be paid to satisfy what is due to me, what is on the tax bill. Okay, so it's very important for you to know that. A lot of people want to sell the houses, but when there's a lien on it, you might say, oh, there's a profit on the house, but no, when there's a lien on it, what happens that the seller or the buyer will calculate, of course, there's always a search to find out if that house, there's lien everywhere. So if that house is lien on that house, then there's going to be an issue, right? There's going to be an issue when you want to sell the house. But some people might not even say, okay, they might not even buy. But the issue here is that if you are owing the IRS, if you're owing the government, the lien on that house, there's a lien on the house, meaning that anything you do on that house, selling or anything, the house, that part of that payment must be made to them, right? We're talking about back taxes. What are the implications? What can the IRS do? Okay. And then, of course, we know about, when I talk about garnishing, that's part of levy. They take your money, right? Now, but we're talking about, I'm focusing here on small businesses, right? Small businesses, because sometimes they even have property, you get, that's the part of it too. All right. Then now it can happen because sometimes the Department of State, Department of the State Department, the State Department might actually seize your passport. They might just, limit your travel, revoke your current passport, just to make sure that you don't flee. They can do that. They can do that. So, and then of course, they can actually sell your property. That's even, they sell your property. They said, okay, I'm not even waiting. We want the money now. They sell your property. So, when you look at some of these things and you look at some of these enforcement actions, you ask yourself, is it worth it when there are so many ways out? And now remember, I started by saying that if you call the Internal Revenue Service and tell them, oh my goodness, this is what's happening to me. They work with you, but again, they have to verify that you're not telling fables, right? Not saying something that is untrue, right? Because if you say you cannot pay and yet you have property all around the country and you have investments and this, and you still say you cannot pay, then that becomes an issue, right? So, but if there are actually people that need help, that things happen, they fell on hard times, they lost somebody or something happens to them. Well, in that case, yes, they listen, because they investigate. They don't just take your word of mouth. But at least you came to them and said, you know what, this is what I'm going through. This is what's happening. Can I have some leadway? Can I have some extensions? This is what's happening. Of course, interest and interest will continue to accrue, and of course on the taxes. But the good thing is that nobody's going to say, okay, yeah, I didn't hear from them. I'm going to levy. I'm going to place a lien. I'm going to sell the property. There's going to be summons, right? I'm going to even revoke, go up to the level of revoking your passport, right? Yes. It's not, it won't happen to you because you're transparent. You actually told them this is what is happening to me. All right. So that's one thing that you should note when it comes to some of the enforcement that can happen when the Internal Revenue Service says, you know what, I'm coming for my money. I'm coming for my money. Okay. All right. So now the next step I want to say is that how do you prevent this? How do you prevent prevent this kind of enforcement of these back taxes? Now, if you're a small business, which small or medium-sized enterprise, a lot of people, what they do is that they open two accounts, let's say for payroll taxes, and they move the payroll tax to that other account. They move to that other account so that there will not be any issues. Okay? They move the payroll tax every time they pay somebody. So I have this account for payroll tax, so that amount that is due is moved into the account, and they don't touch that account. That it just helps you to be disciplined, because you might say, oh, there's a lot of money in the account, but some of the money doesn't belong to you. It belongs to the government. So what they do is that they separate it. They have two business accounts and they separate them. That helps. You don't have to do that, but it actually helps to try, move that money to another account. The second thing that you can do, something else that you can do, is they might be estimated taxes, right? There's some business structures which I will summarize at the end that will say, you know what, the taxes don't come from the business. The taxes come from you, right? Because they flow through pass-through entity. If that's the case, the same thing is that just estimate your taxes. You can even estimate tax payments, and you send it, by the quarter, send the payment. Because at the end of the day, if the money is too much or you've overpaid, I won't say it's too much, I'll say you overpaid, you get a refund. You get a refund. It's not like they're gonna, you get a refund. It's not like they're coming back and say, oh my goodness, you did this. No, you get a refund. All right. Oh yeah, they won't say, oh, you gave us so much money. No, everything will be calculated and you get a refund, right? So another thing that people do now that would help. Now, if you are working in your company, and you keep on seeing that you're paying a lot of taxes at the end of the year when you do your taxes, I will suggest that you should also increase your withholdings, because there are some tax structures that actually allow you to work for your company. Now, of course, you know that LLCs, unless you're taxed as an S corp, you can't do that. You can't work for your company. You can't be paid under your company, or you're taxed as a corporation. But if you're in those kind of entities that you're actually taxed as an S corp. You can actually, or a corporation, you can actually work and be paid a salary under that umbrella. Okay, can be paid a salary under that umbrella. All right. Now, the good thing about that is that when you're paid a salary, just check your withholdings. Let your withholdings be reasonable. If you're earning, maybe 100,000 a year, just check the withholdings. You can even do more and say, you know what, even if you're a married person, say I'm filing as a single person. Why? Because it gives you more withholdings, right? Right? Because sometimes people have more than one job. Sometimes their spouse is also working. So with that, if you have more withholdings at the end of the day, or your spouse, you will not have to pay so much in taxes. So you will not have so much in back taxes. So I would say that as much as possible, do estimated taxes, separate payroll taxes from your own money, from your own account, and also increase your withholding. And then finally, remember I said what will prevent all this? Pick up the phone, or I won't say really pick up the phone, because I always advise people speak through your CPA to the Internal Revenue Service. It's really nice. Really nice. I believe it has many benefits. It's nice too because the benefits, but I would say speak through a professional, because there are questions that will need to be asked and answered, and it might not be your field. So it's very good for you to have someone that is sort of an intermediary, and just make sure that everything is situated if you already have back taxes at this time. All right. So now we know the implication, the prevention, and then let's look at some options. Now, let's say now you already have the back taxes, right? Now, of course, there are various ways to make sure that that is paid. There are installment agreements. There's a course I'm going to actually talk about that at the end. We're going to a couple of minutes to break what is out there for everybody under my learning platform. I actually mentioned that I've started a learning platform that you can actually take courses at very minimal price, where you can actually learn and understand what these few things that I talk about, or a lot of things I talk about on this platform, because I can't go. It's not really in depth. I can't really go in depth with everything because of time. But I wanted to really make a difference, to make sure that people have the knowledge base. Now, so when we're talking about options, you have back taxes. Now, what do you do? Of course, there's installment plans. The thing I will always say, that be engaging. It's not, don't step back and say, I'm not going to call, or I'm not going to communicate with these people that you're owing, because if you're on the other side of the fence, you will not like it. You won't like it. So think of that. So yeah, make sure installment plans are available. There's delayed, maybe you want them, when you want them to stay action, you can, there's temporary delay, and say, process it later. They look at your situation and just not really go ahead and put any lien or levy, things like that. They would just talk to people. Talk. First of all, is talk. Talk is one of the options. And then, of course, I said installment plans, and then a temporary delay. Yes. And then offer in compromise, just like the name says, offer in compromise. What is it that you can offer in compromise? What is it that you can offer? Maybe you're owing 80,000, 100,000 in taxes. You say, you know what, I want to pay a bulk sum or a bulk amount so that it can wipe away this 100,000. What is it that you can do for me? And that's where the offer in compromise comes in, right? There are a lot of details, a lot of things that entails, but that is some of the things that's something that the Internal Revenue Service just comes up and says, okay, let's go. We can do it. We can come up with an amount. Now, with an OIC, offer in compromise, even the temporary delay in collection process is not automatic. It's not like they say, oh, hello, please, I want to have an OIC. Can you have an offer in compromise? Oh, yes, I'm so excited. Let me give you, oh, yes. IRS will say, yes. You want to give your offer in compromise? Want to give us some money? Okay, that's fine. Let's go ahead. It doesn't work like that. Oh, temporary delay. Okay, I get it. No problem. We're going to temporarily delay collection. Doesn't work like that. Of course, analysis. They want to make sure that when you say that you don't have the money, you don't have some kind of money stashed somewhere, and you say, oh, I don't have the money to pay. Because some people have the money to pay, but they just don't have the money to pay taxes. They have the money to pay for other things. So when they hear about offer in compromise, they get so excited. But IRS say, okay, let's see, do you really qualify for an OIC, right? Or do you really qualify? And so you go through the motions, check this and look at this. Do you have assets and things like that? Because again, a lot of people have money and they say, yes, this is the time I'm very good too, but they don't want to, I'm very good. I want to enjoy and travel, which is good. There's nothing wrong with having fun with your money. But if you're owing taxes, that's not your money. That money you're owing is government's money. So yeah, so that's why it's not automatic. Buyers will go through there's some forms, some analysis, and all kinds of things to say, okay, yeah, this person actually qualifies for an OIC. This person actually qualifies for a temporary delay in collection. Yes, we understand. This is okay. We will work with that person, right? And then also, sometimes people say, you know what, I'm going to pay with a credit card, because the credit card actually gives me another 60 days or so to pay, or depending on your billing cycle. There's okay, yeah, I can pay, and say it gives me 2 months to pay. The difference between a credit card, as long as you pay it off, and the IRS is that daily compound interest. So people go the route of the credit card because, okay, yeah, I can do it because it gives me 2 months to pay, depending on how you process your thing. You can say, oh yeah, it gives me some time to pay. So just wanted to make sure that these are some of the options, right? There are a couple there, but I mean, we can't go through every single thing, but these are some of the options available, right? And then when you're even doing the installment agreement, because there's also installment agreement, which I mentioned, when we're looking at the installment agreement, the issue here is, are you actually, saying that you want to, want to make installment agreement that is really, really below the amount you can actually afford to make? So all those things go into, one goes checks all those things to make sure that the exact amount, because the installment agreement is there, is available, but how much can you actually make as an installment? How much can you make? So that is it, right? And of course, as even with all the installment agreements, I mean, OIC is different because it's done. I mean, usually people that do OIC says they pay the money and that's done. But when it comes to installment, in any balance you have, interest and penalty continues to what? Accumulate, right? Interest and penalty continues to accumulate. So it's so important for us to know that these are some of the options. But, I don't really want us to get to the options. I want us to make sure that we are very proactive as business owners. I said one of the key words you should have as a business owner is what? Being intentional. You have to be intentional. So when we talk about prevention, it's like, okay, yes, I see that my taxes were high last year. This year, I'm going to make estimated tax payments. I'm going to increase my withholdings, right? I'm going to and make sure that that if there's any way that I can, I said increase my withholdings. I also mentioned estimated tax. Or is there any way I can make payments ahead of time, right? Remember that I talked about payroll taxes ahead of time within myself. When I say payments, I'm saying that I would, let me just say, not really transfers. I would say transfers. But sometimes you might even, I would say some people might say, what about if you want to make payments ahead of time? I mean, I would really suggest that instead of making payments, ahead of time is good, don't get me wrong, but let it be complete. Complete, right? If you want to make a payment for maybe Q1 of, let's say, 2023 for 941, just instead of doing half, put half in the account, in the separate account. Then the other half, you can put it when you're making the payment. So everything will be together. And you say, this is a 941 2023 payment Q1 for ABC LLC, okay, or ABC Incorporation, Inc., or Corporation or Inc. or S Corp, whatever your entity is, right? And then I want you to say something. I said, even though I said you cannot pay a salary as an LLC, you pay a salary to yourself as an LLC owner, but of course you can pay your staff. You're allowed to pay your staff that amount of, you can pay your staff, that's fine. It's allowed. Pay your staff, pay your employees. Yeah, pay your staff, your staff, which are your employees, but you can't pay yourself as an LLC, an owner of an LLC. Okay. All right. So just wanted to highlight that because, one thing, we're almost done with the first quarter of 2023. Very exciting. Almost done. But the goal is, for this platform, the goal is for every business, every SME, right? Anywhere in the world, listening to this, right? They'll say, okay, yes, it's very important that I put an effort so that my business can thrive. A lot of small and medium-sized enterprise, they might not really have the knowledge base, because most of these large organizations, they have someone that has that knowledge base working in their office. Now, wherever, these are some of the issues, enforcement within the United States, but I wouldn't be surprised if I wouldn't be surprised if in other countries we don't find something similar to this. I wouldn't be surprised. I'm not saying that exactly, but similar to this, because the goal is that, is to run your country. And most of the time, most countries, there a lot of their revenue comes from taxes. A lot of their revenue comes from taxes. Like a lot, so a high percentage. So they have to make sure that they get the taxes to be able to provide amenities for the citizens of that country, or including here, the US. All right. Okay. So hopefully I've been able to share something, but let's move to the next, because I have something exciting. I know I mentioned it before, but I'm going to share my screen You see what I'm talking about? Okay, let's go to the questions. I think I have some questions here. Questions. All right. Right. Okay. Some of the questions. Hello. Yeah. Yes. Yeah. Okay. Yes, I have a rented office, but I also have a home office. Can I claim that home deduction as a deduction? Okay. I would think that this is someone that is um, um, well, I'm not going to look at the structure, but I'm going to talk about generally, of course, a business owner, because I would have gone into structures, but I want to say that towards the end. Now, as a home office, you are actually allowed to deduct that, but there's something called accountable plan. So how do you deduct it? Well, is there a policy in place within your office? Because if you're having a home office, right, you should be able to get a reimbursement even from your office in your company. Because when I say your company, because I mean that means that you have two locations, and your home office is like a location for your business. There are people that work from home 100%. There are people that have a rented office. After COVID, so many things happen. After COVID, what happened is that a lot of people said, you know what, I prefer not having a brick and mortar office. Some people say, yes, let me still maintain that, but most of my work I'm going to do from home. A lot of times people prefer, let's do Zoom meetings. They prefer, communicating with, virtual, they prefer virtual meetings. So if you have an accountable plan, right, you can work with an accountant to clarify, let that, make sure that you understand what that means. Then the company can reimburse you. So deduction would be the company would just issue a check, and then that would be and then the company, then that home office. Now I'm talking about usually for a corporation, S corp, but I know that some people have there's a part on the 1040 Schedule C that says home office, but when you're looking at the corporate returns, there's no part for that. So what usually happens is that, especially when you have an accountable plan, not especially when you have an accountable plan, what happens is that the company should issue you a check for use of that office. And it's just like you're renting the second office, second location for an office, right? For an office, as I said, the COVID really changed the dynamics of how a lot of people used home offices, and a lot of people used going to meet people out of their homes, right? COVID changed a lot of things. So I would say yes, you can also deduct it, of course, deduct it in a proper way. Again, you have to make sure you work with a professional that knows what the person is doing when it comes to how to deduct it. But you allow, but make sure there's accountable plan, make sure that everything is done correctly, making sure that everything is the way you deduct it is done right. Okay, hopefully you understand this. Okay. Okay, so another question is that I moved for work. So the question is that, can I deduct moving expenses? Okay. Now, I know that before when you move, you could actually deduct moving expenses, but there were some changes, which now you can deduct work related, but moving expenses, but there are some conditions, right? A couple of conditions. I'm not going to go through all of them, but mostly if it's at least 50 miles away from your former home than your old job was, then that's one of the situations. But again, I would say that do a proper analysis. Yes, generally you can deduct, moving expenses related to business, but conditions apply. Okay, conditions apply because they're not just moving for, you're not just moving for moving sake. People just are relocating and they just pick up their bag and leave. That is not moving. That's not deductible. Of course, I'm not going to say it's not moving expenses. Please, it's moving expenses, please, but not deductible. Okay, so I'm not going to say it's not really. So it's not deductible. All right. Okay, so yes, so for work, it's a different ball game. Make sure you're looking at it. What is the mileage, the distance, right? Looking at the distance between your home and your former workplace, your new workplace and your home. So just there's some calculations, and also looking at some other general analysis to make sure that yes, you can move. Okay. Okay, you can deduct it. Of course, you have moved already. So yes, you can deduct it. All right. Okay. And then the next question is that my 1099 is less than the total work my business perform. Is that a problem? Okay. Now, this is someone talking about the tax form, the 1099. And the question is that is less than the total work the business performed. Well, sometimes it could be less. Maybe they did not record everything, right? But that is, see, your job is to. I mean, you can actually you can still tell them to correct it, right? But you need to make sure that everything that is recorded on your tax return, all the income. I mean, if they made a mistake, that's their that's their issue. But you have to make sure that everything that is recorded, right, from this client or from this customer, everything recorded in your tax return is accurate. You know what can happen? Maybe you even didn't tell them that, what they said, what they provided is inaccurate. You might not tell them. Then they find out later, oh my goodness, I sent this client an incorrect 1099, right? An incorrect 1099. I mean, and because of that, you relied on their 1099 and you sent your tax return in. Of course, there's going to be red flags because everything that a company sends to the Internal Revenue Service, everything the company sends, every analysis the company sends, every tax form is compared to the tax return that you file. Okay, there's analysis. So the tax form that is sent by the company, right, is or by anybody that sends a tax form is also compared with your tax return to see if everything was reported. So even if they send you a 1099 that is less than what you worked, make sure you calculate how much you worked, how much work you performed, and when I say how much work you performed, calculate how much income you received, total income, and put it on your tax return. Okay, put it there. All right. So don't just say, oh yeah, they give me a 1099 that is not actually the same, and so I'm good to go. No, you're not good to go. Make sure you are calculating exactly what you received. All right. Right. So yeah, and that's just wanted to make sure that we're aware of that. Okay. Let me see. We can take one more question. Then I will go into what I have for you. I've been saying things that I'm pushing it to the end of the show, towards the end. So I'm just going to see if I can have one more question. Okay. The question here is that I am resident in Atlanta, but I sell products in different states. Do I pay taxes on that? I believe, I believe this is about someone that is doing I believe it could be online sales, because if somebody is resident in Atlanta and sells things around the country, I would say, or whether the world, but I would say if it's around the US, I would say that the big issue is sales tax. Now, I believe I mentioned this in one of my episodes, but just in case you didn't hear this, so I want to mention it again. Now, before, it was all about the brick and mortar store. If you have a brick and mortar store in a state, before, you only charge sales tax in the state where you have a physical presence, which is where your office is. And now, physical presence in one state means is sometimes different from the term physical presence in another state. It is sometimes different, but usually it's when you have an office space, right? Now, South Dakota went to court, right? So we went up to the Supreme Court. It's South Dakota versus Wayfair. And because people that know Wayfair is an online store and furniture store. And because of that, South Dakota said, you're selling a lot of items in my state, but you're not paying sales tax. And then, of course, it was all about the physical presence. But, well, the Supreme Court sided with South Dakota and said that that's fine. They can go ahead and charge sales tax. So that changed the dynamics of selling things selling things online or products online, because it was that there was no physical presence. Now there's something called economic nexus. Economic nexus has to do with two things. Economic nexus means the number of items sold and the quantity, when the amount, the threshold, the number and the threshold, right? Some people will say, some states will say, okay, if I sell 200 items, then if you sell 200 items, anything above that, sales tax. If you sell things up to 100,000, anything above that, they sales tax. So please make sure you know the laws. Make sure you find out, okay, what is it that I have to charge? Which states, right? You might want to work with, partner with most of these marketing platforms where they sell products, help people that are, people that are online, that sell online. They really, I believe that they would align with those sales tax. They will align with those issues of sales tax. But it's very important for you to know that. All right, hope we've gotten something in, but I want to show you everybody something. I'm going to share my screen now. All right. Awesome. Now I've been mentioning that now I have some products online, and this is it. Global Institute for Advanced Learning. So if you come to this website, giadvancedlearning.com, then advancedlearninginfo.com, and you click on access courses. All right. And of course, all products here. Now you find out a couple of courses here. I have courses that include business structure, how to financing options, payroll taxes, employee retention strategies, strategies to increase your business revenue, a couple of courses like that. And have business deductions, a couple of, and then debt settlement issues. Now, I just felt that this was necessary because a lot of times there are no resources out there. There are sometimes, but how to put everything together. So this makes it a little bit easier for people to have the knowledge base. Of course, it's the educational platform, and this is tailored towards entrepreneurs. We have other courses that are coming up, but just to make sure that entrepreneurs have general information and on a couple of things, right, that will make a difference. So and make your business, of course, thrive. So if you can, you can take advantage of these courses, and just make sure that that it's for knowledge based. But honestly, it's I believe, because it will make a difference, because I strongly believe in theory and practical coming together. Theory and practical. A lot of people teach all theory. They don't bring the practical into it. And I've gone to school for a long time, and I found out that those that brought the two together, the theory and the practical, made a very huge impact for me when I was in school, and also when I'm teaching other people. That's the platform I stand on. Theory and practical aspect of learning. Okay, so I'm very excited. So again, GI Advanced Learning, giadvancedlearning.com, info. So that business structure I was talking about is there. Business deductions there too. All right. So I'm very excited that I'm able to share and also make a difference in the life or phase of the businesses, and of course, entrepreneurs which at the businesses. All right. So I hopefully, right, this year is going to be an intentional year. All of us are going to move forward. Remember, to thrive, you must be intentional. All right. So very excited that I'm here today. See you next time. And as always, thanks for joining me. All right.